Hey everybody, it's Mark Yagi here. And a few months ago, a friend of mine, actually a client in my mastermind group, asked me, he said, hey, listen, can you help me build like a $10,000 a month income and do it fairly conservatively, like on the SPYs or the QQQs? Now, normally I don't do the SPYs and the QQQs. A SPY is the S&P 500 and the QQQ is the NASDAQ 100. I normally don't do those because there's just not a lot of volatility and not a lot of juice. But he wanted something on the safer side that he could kind of count on. So I said, let me see what I can do, and I'll put together something for you that I know your temperament, I know your risk tolerance, and I know that you'll probably like this. So I put together this retirement strategy basically to get him $10,000 a month using only a couple $100,000, and that's just part of his portfolio. He's one of my mastermind clients, so he's got a decent net worth. But I wanted to be able to help him and maybe help you and show you step by step exactly how I put this $10,000 per month income plan together. So I want to show you here what you can do by taking a $200,000 investment portfolio or part of an investment portfolio, figuring out how to make $10,000 a month, which $10,000 a month times 12 months turns into $120,000. And we'll look at it as an annual salary, right? And so that's how you can do it. Now, it's a 60% return. It is not the easiest thing to get, and I'm not guaranteeing you're going to get it. But if you look at it like a salary, if you look at it as a safe investment, I'm going to show you how that stacks up here. So what we're going to do is we're going to use what are called LEAPS. I also call them synthetics in my courses. Some people call them poor man covered calls. I hate that because I don't think you should be poor when you're talking about the stock market. I think you should think abundantly. So I hate the term poor man covered calls, but that's what some people call them. I call them covered calls or covered leaps or synthetics. So we're going to talk about how to do those right now. So the first thing we could do is look at the S&P or the QQQ. Now the QQQ is a little bit more volatile, so it's a little bit more in my sweet spot, and I knew that it would work for him. I'm choosing to do the QQQs because, well, I like the way the chart is setting up, frankly, and I want to show you that right now. So the first thing I want to do is I want to be entering the market when I've got the stock market on my side, right? It's always nice to buy a stock or buy an ETF and it goes green immediately, right? Tells you that you were kind of picking it right. And I believe that market timing is a critical component. If you've watched my channel, you know that I have 4 cornerstones for doing covered calls and doing them right. It's to buy the right stock, or the right ETF in this case, in the right market, at the right spot on the chart, and then we squeeze the juice. That's the income we're getting from doing the ETFs. So looking at this screen right here, this is my market timing screen, and you can see this little green box right there. That tells me that we're in a green market. Now, most green markets are going to last 12 to 18 trading days on average. Now, some are more and some are less. We just went through a period where we had a 40-day run, and then we've had some runs here that are pretty short. But generally thinking about 12 to 18 days, that gives me a good, nice runway to get in the stock and turn green so that I have a cushion. So I like the way the market is setting up. This is the weekly on the QQQ, and you can just see that, over a long period of time, this is going up. It doesn't take a brain surgeon to see that, right? And so you can see that it goes up and it goes down, but it goes around generally that line, which is an upward trending line. So we know that over time, that line is moving from lower left to upper right. So we know that this is a long-term trade, right? We're going to get some ups and downs, and we know that, but this is a long-term trade. I hope that makes sense. Let's look at it on a daily, and I'll show you why I like the QQQ right here. There's a couple of things. First of all, we've got this little cup with a deep handle right there, but basically it's telling us at the top of the handle, which is roughly in this area, 485.54, is the breakout spot of it. Look at the price. It's 483.58, right? So we're right close to the breakout zone. That's number one. Number two is there's a downtrend line there that it broke above, and it gapped above that. I like that, right? That looks really good to me if you can get a gap above that. Third, we're doing some decent volume here on that gap up, and I like that. That's telling me that things want to go higher. I don't know if I'm right or not. I'm just trying to stack the probabilities inch by inch, little by little on my side. And so then I see that all-time high is 503.52, and I know that all the other indexes are trading at their all-time highs. The S&P 500, the Dow, and the New York Stock Exchange all at their all-time highs. And the only one that isn't is this QQQ. That tells me that it's got, I don't know, 8% left to run before it breaks to its all-time high. And then if it breaks above that, on some decent volume, hopefully, then we're going to run higher. Well, we know what the long-term trend looks like. And so if we're right, we continue to just buy this long-term trend. But I want to show you how to do it rather than just buying the ETF and hoping that it goes up. We're trying to create income here, okay? So I want to show you how I talk to this person and how I'm talking to you right now about how you could do it right now, not 2 months ago, but right now. So I like to buy things when they're trending higher. It kind of gets the probabilities on my side. So that's why we're looking at the QQQ right in here. It might go up, might go down $1, $2, $20, $30, whatever. We're trying to get in this for the long term. Now, what we're going to do is if we wanted to buy 100 shares of this, it's going to cost us roughly $48,371 for just 100 shares. Okay, so just remember that number. $483.75 times 100 is $48,000. Well, it's kind of expensive to just control 100 shares, but using LEAPS, which are long-term equity anticipation securities, something like that, they go out pretty far. Now, what we're going to do is we're going to look at this option chain, and you can see I'm going to go out as far as I possibly can. Today is September of 2024. I'm going to look at going out to the January of 2027. That's why this is a long-term trade, right? And you saw what the long-term chart does, so I feel safe going into a longer-term trade. Now, here's how I would look at it. You have all of these different options, right? These are options that you're going to be buying instead of buying the stock. So what I like to do is I look here and I go between an 80 to a 90 delta. That tells me that I've got an 80% to 90% chance of being in the money around expiration time. That's kind of the way the market is pricing this, and they set this little calculated delta, okay? And so in this trade, what I'm going to do is I'm going to look somewhere around an 80 delta, 0.8 is the way I call it 80, but 0.8 puts me around the 405 strike price, okay? So that's about $80 in the money, okay? So what I'm probably going to do, just because I like to round the math down, is I'm going to do the 400s. There's usually more trading on the even numbers anyway. And so you can look, there's a big spread on this, 130 by 134.50. I don't want either one of those. I don't think it's fair, but I'll probably get a fill somewhere in between. So it'll probably be a little bit more because we're going to be buying this for less than 134.50, probably somewhere in between, like 132. So figure that the juice is going to be about 46.28. Let's back up for a second. Now, instead of buying the stock for $48,000 for 100 shares, now we can control the same amount of stock for $13,200 or $13,480 if it's on the ask there, right? So that's a lot cheaper. Basically, we can buy 3 to 4 times the amount by using a leap. Now, there's risk to doing that, right? If the market starts to crash, we go into a bear market, which everybody's been saying, but everybody always says that, and they're always wrong, except for like twice every 10 years, and then it always recovers. You have to play the probabilities. And you say, well, you know what? It could go down, and then I'm going to have some strategies for what happens if it does. But if it continues to go up, this delta is going to go higher, and I'm paying $13,200 for that 100 shares to control that 100 shares. So that's how we look at that, okay? So that's our base position, what I call our base position. It's also called the synthetic. And so you can see that it's a superior cash flow management situation to buying $48,377 for 100 shares. Instead, we're going to spend about $13,000 and change for 100 shares. All right, so now we've got the base position built. We're just going to go buy that. You right mouse click on that. You hit the buy button. Probably put a limit order somewhere between this 130 and 134, right? So let's just do that and show you. So you hit the buy button, and you build this little order entry system right here. So you're going to hit the buy button, and you're just going to build that order, right? So, you can put in how many contracts, and each contract is worth 100 shares, by the way. So you put in how many contracts, and then you add whether it's a limit order or a market order. I normally like market orders, but on something that has this big a spread, I'm going to put a limit order, and I'm going to go at the midpoint and maybe add a little bit of money extra for the market maker to be able to, stay in business. So I'm probably going to give him another 20 cents or something like that. So let's just say we go in at 132.60. And I still think that's a fair price, and I'm not in a hurry to get the execution. Okay, so now we've got our base position, and how do we analyze how much income we're going to get? Well, let's go all the way back up on the option chain. You can see that there are 0-day options, things that are expiring today, they're expiring tomorrow, they're expiring 2 days from now. So you have dailies, weeklies, monthly. I like weeklies, but you can choose dailies. It's just a lot more work. You could choose weeklies, you could choose monthlies, which is way less work, but also less percentage return. And we're going to go out, let's call it a week. So we're going to look at those 7-day options. And what we're going to do is we're going to look for an option that is above the strike price. And I like options with about a 30 delta, okay? Now, that's going to give me a 7-point upside potential. But maybe I should go to, I want to hold this for a long period of time. Why don't we go to like a 20% chance of getting exercise? So that will be somewhere in the 493s or 494s, okay? Now, if we do those 493s or 494s, let's just pick one and say we're going to do the 493s, okay, which have a 21 delta, a 21% chance of getting exercised. That's $1.24 in juice. That's $124 per contract that we get every week, okay? That's roughly $5 a month. Okay, so remember that $5 a month. So we've got $13, and let's call it $13.20, and then we're going to end up making, $1.26 every week, or $5 per month. So now what we're going to do is we're going to sell those calls. That's our income. That $1.26, $1.27, whatever that price is, looks like it's jumping up right now. That's what we're going to sell, and we're going to collect that income. So you would just go click on this, hit the sell leg, build your order, how many, what the quantity is, if it's going to be 10 contracts or whatever. And in this case, I would put in a market order because, look, it's only trading $1.28 by $1.30. There's only a 2-cent spread. It's not like a $3 or $4 spread like we saw in the base position. So I would just go ahead and get the execution after I've got my base position, and I would put in a market order and submit that order. Okay? That's how that works. To understand how LEAPS work, let me give you an analogy. And this is an analogy that I like to use. I've got several analogies that I use because it makes it easy. But most of the real estate analogies that I have are pretty good. So let's say that you went out and bought a house. And your goal was to own this house after, a couple of years. But while you were paying the mortgage, you had an Airbnb, and you were Airbnb-ing this thing out and just doing short-term rentals. People would come for a week and they'd rent it from you, or a day or a month, and they'd give you money. The idea is that money comes into you, you pay down your mortgage, right? And over a period of time, you pay off the mortgage and you own this free and clear. Now it's just potential profit. It's the same thing we're trying to do with these LEAPS. So we're trying to buy them cheap, right? Or we're trying to buy them, but use the juice every week to pay it off, so that the end of this, long trade that we have, it's all free. It's free money, and then we can choose to sell it or continue to go out another 2 years and keep making our income every month. So let's say we can get that $1.26 in income. We've paid $133.20 approximately. That means in 111 weeks, this is all our own position, totally paid for. It could go all the way down, and we still haven't lost money at that point. But we will still have it, and the idea is that we'll still keep making income, and we'll just keep moving the position out and keep doing it again. Plus, we'll probably get a little bit of capital appreciation on it. I mean, if the NASDAQ goes up 10% a year, which is fairly close to what it's been doing over the last, 50 years or so, we should get another $96 out of that position. And so, factoring in the delta, we'll end up making another $80 to $90 per share, because remember, we have an in-the-money option. And that in-the-money option moves dollar for dollar minus a little bit of delta to go up. So we'll pick up another $90 or so. Probably call it 80 to be conservative, because sometimes it's going to go way up above our strike price. That's going to be pretty rare because we only have a 20% chance of happening. So we're going to get, an extra bit of money on that. So let me show you in a second how that math works out. It's pretty cool. So the first thing we want to do is we want to calculate the number of contracts that we need to purchase. If we're starting out with a $200,000 investment amount, we divide it by that 133.20 or $13,320 per contract, we come up with 1,500 shares or 15 contracts overall. Okay, next let's do the math on the whole trade. So if we get 15 contracts, remember, one contract is 100 shares, so that's 1,500 times 133.20. It's $198,000 investment, and then the juice is $1.26 times 1,500, which is $18.90 per week. So that's the income. Now, we are going to get, hopefully, if the market continues up on average like it normally does, a QQQ increase of about $80. I know we said 90 or so, but got a discount for Delta. So 80 times 1,500 is $120,000 of extra increase in the value of the QQQ. So overall, we're going to add the juice, which is $196,640. This is a 2-year period, let's just call it, 54 weeks. And then adding then the $120,000, and that gives you a total of $316,560. Okay, so what we're looking at is a 2-year return. If we take all that number and we add it up and divide it by 24 months, and this trade goes longer than 24 months, but let's say we stop at 24 months and close it out, and we've had our capital appreciation and all the things that we assumed, we're going to end up with $13,190 per month. That's more than the $10,000 we set out to shoot for. Now, things happen in the market, right? And so if they happen, I've left some cushion in there. I've left, $3,190 of cushion. So maybe it doesn't go up 10% a year. Or maybe we end up getting a little bit less juice on a few of those weeks. Or maybe we stop being in the market for those 4 really critical weeks, going into Thanksgiving or whatever. We have some other things. Look, I got a cushion in there on the juice that you would make. So I think I've shown you that if you invest like this using LEAPS, you can, number one, you can replace the stock and control the same amount of stock with about a quarter of the money. Or you control 4 times the stock with the same money. You can look at it like that. And then if you just shoot for getting that small percentage return every single week, and maybe you get a little capital appreciation on the top of it, I don't think that's outlandish. And one thing I didn't talk about is the slight increase in juice you're going to be getting every week if the stock goes up. So right now we might be getting $1.26, but if the stock gets more expensive, it might go to $1.36 and maybe $1.46. I'm just trying to be really conservative, but you can see there's your $10,000 a month on a $200,000 portfolio. Make sense? Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.